inflation. But that there in itself doesn't lie the problem as to why the Fed's actions are going to bring the whole house down. So let's get into the brass tacks, and I'm going to do this quick. So pay attention, take notes. And if you're still not convinced after this podcast, go watch some of my videos on YouTube, watch Ray Dalio's videos, or any economist or any hedge fund manager you want. We're all saying the same thing. So the first thing that happens after they print a whole bunch of money and they drive a whole bunch of inflation lands us to right here, right now, May 2022. Inflation at, I think right now it's 8.3% and probably will go higher. So when inflation starts getting out of control and there's more demand than there is supply because of shutdowns of China, shipping and trade is all at a halt and lots of other things, but there's still demand because there's lots of money and everybody feels rich and they can borrow money cheap. So what is it that the Fed does when they want to slow the machine down? We already know this. They announced at the beginning of the year that they were going to start raising interest rates. Well, how many times? Well, how about 7? In 2022, the Fed, a Federal Reserve, is going to raise interest rates 7 times. Just this month, they raised rates again. So the first increase was 25 basis points, 0.25%. No big deal. The second increase was 0.5%. 0.5%. So now 0.75%, they have raised interest rates. And what is the effect of that? Well, if you've got a line of credit, you see the effect. The price and the cost of you borrowing money from that line of credit has now gone up. There you go. So now it costs more money to use your lines of credit. How about car loans? Yep, those went up too. How about mortgages? Yep, you used to be able to get a mortgage. Heck, I mean, in the peak of the pandemic, just a year ago, in a peak of the pandemic, we could get a 30-year mortgage for under 3%. Last year, you could get a mortgage for 3 to 3.5%, give or take. Awesome. How much are they now? Well, let's just talk about after they raised interest rates 0.25%, a mortgage rate went up to over 5.5%. And that was only a 0.25% increase. Oh, you're wondering why it's not dollar for dollar, percent for percent? Yeah, that's interesting, isn't it? They just raised them 0.5% recently, which sent the markets tumbling. The day that they did that, it was anticipated that they were going to raise interest rates 0.25% . So the market rallied. The next day, the market fell 1,100 points and it continued to fall right up until today, which is one of the first up days that we've had. Maybe there was one other one in the middle, but it was short-lived. Well, 0.5% interest rate makes money more expensive to use. Money for cars, money for houses, money for boats, money for planes, money for margin accounts in your stock brokerage. That's right. Everything is getting more expensive. And the reason the Fed is raising rates 7 times is they want to slow your demand down. They want to slow you down from buying so much shit. That's why they're doing it. But in doing that, you're going to start halting the economy and bringing it down and slowing it down to curb inflation. Will that result in a recession? Probably not by itself. All that will do is slow things down, bring us down back down to a normal inflationary period, which that's their hope, but they're probably not going to get there because there's some things that they're missing. They acted too late, definitely acted way too late. So there's definitely going to be inflation, I don't know, into the foreseeable future. But that inflation is going to give way to one of two things, probably stagflation and then definitely deflation, which we'll cover in a second. But so the first thing that the Fed did, trifecta number one, or part number one of the trifecta would be the way to say that, is they're raising interest rates 7 times, making it more expensive for you to buy things, making it more expensive for everyone to use all that easy money that they printed and ran through their central banks. Number 2 of the Fed trifecta. If you were paying attention, the Fed announced back the end of last year that they were going to unwind the balance sheet. So any of you that understand what a balance sheet is, it's assets, liabilities, and your equity. So on the Fed's balance sheet, when they print money, and they trade the money for debt. Those debts sit on the balance sheet as an asset. It's a liability to the US government because they owe the money to the Fed, and to the Fed, it's an asset. As of right now, May of 2022, the Fed, as they announced, has roughly about $8.9 trillion of US treasuries and mortgage-backed securities on their balance sheet. They have been buying these bonds from the US government since 2008, and it has blossomed the balance sheet to a whopping $8.9 trillion. Now, the trillion word gets thrown around all over the place, and a million is the new billion. I just want to be clear. Like, we all hear trillion thrown around, but do we all understand how much money $1 trillion is? None of you listening to this podcast could ever spend anywhere close to $1 trillion in your lifetime, or probably 20 to 100 lifetimes. You could never do it. But they have $8.9 trillion. And let me put that into retrospect in a different way. If you took the top 5 nations, China, Japan, Luxembourg, Ireland, I'm missing a couple, Ireland, and there's one other one, China, Japan, Luxembourg, Ireland. Sorry, I'm missing one in there. If you added all of them up, all of them, they're not even half of what the Fed has on its balance sheet. Not even half. That's how much money the Fed holds on their balance sheet. And they announced they're going to unwind it. So what does that mean? They're going to start selling the bonds off into the open market. That's right. They're going to sell some of that $8.9 trillion, and they're going to let those bonds mature, and they're going to sell them into the open markets. So what does that mean? Well, when you sell something, somebody else has to buy it. So when you sell it in the open markets, Wall Street, if you will, or you mature it, that means it sucks money directly out. Now, just for a second, let's pivot. All of you probably saw the movie Spaceballs. So close your eyes and just imagine that movie, Spaceballs. Remember the part where Helmet and his bad guys roll their big black ship up to that planet, which was clearly Earth, but they called it something else. And then their spaceship converted into a maid with a vacuum cleaner. Do you remember that scene? And then a portal opens, or the ozone layer opens to Earth, or whatever they called it. And they hook the vacuum cleaner up. And what do? They suck all the air out. The trees are getting sucked out. All the air is getting sucked out. People are unable to breathe. Now, let's go back to the Fed unwinding their balance sheet. The Fed has announced that they are going to start selling $95 billion a month. The first one's going to be like $47.5 billion for a couple months, and then they're going to move it to $95 billion. So remember that vacuum cleaner and that ship that turned into the vacuum cleaner? That's the Fed. So instead of Helmet, now that's the Fed. Earth, what is that? Wall Street, capital markets. They flip the on switch on, it starts sucking money, not air, out of Wall Street. Okay. When they do that, that takes liquidity away. That takes all this easy money that they just printed away, to the tune, if they did that for a year, of about $1 trillion. So they printed $5.1 trillion in a short period during the pandemic, and they're now going to suck out $1 trillion a year or more. They have the ability to change that until they get what they say is a desired result in slow inflation down. That right there, I want you to pay attention to the second thing that we're talking about, which is the unwinding of the balance sheet, which is the vacuum cleaner that sucks all the money back out of the capital markets. This right here has happened before. How many times? Roughly 7 times in history. Now, the Fed was created in 1913. Again, read The Creature from Jekyll Island, or another book called Secrets of the Federal Reserve. You'll understand this. 1913, the Fed was created. So since then, the Fed has done this a few times. Now, let me give you the ability to ask or answer a question. If the Fed has done this 7 other times, how many times when the Fed has done this has it resulted in a recession? What's your answer? They did it 7 times. How many times out of 7 did it result in a recession? So different answers are going to come in. Some of you are thinking, oh, maybe 1. Some of you put a lot of faith in the US government and the administration. Like, I don't know, maybe 2. How about try 6? The Fed has unwound the balance sheet 7 times. And out of the 7 times the Fed has done this, it has resulted in a deep recession 6 of the 7 times. And also, let me add something. The Fed has never in history unwound the balance sheet or sold bonds to the tune of $95 billion. Yellen, the last time she did this, she did it to the tune of about $45 billion a month, and they only did it for a short period of time, which maybe they'll only do it for a short period of time this time. The Fed last week, this is hilarious, announced that they think they're going to pull off a soft landing, which means the two that I just told you, the increasing of interest rates 7 times and the unwinding of the balance sheet, $95 billion a month, those two things, they think that they're going to be able to pull off a soft landing, which is where everything slows down gradually and it doesn't result in a deep recession. So if any of you out there are into statistics or just math in general, what is the probability of that happening? If you ask me, 0. But if you ran the statistics and you said 7 times, it's resulted in a recession all but 1, well, all right, what is your percentage? But they've never done it to the tune of this nature. A week ago, they said they're going to pull it off. But then just today alone, they announced that they don't think or they can't guarantee a soft landing. In other words, we can't guarantee a soft landing. What are they saying? No, we're not going to nail it. We're not going to get a soft landing. We're going to destroy the economy and the walls in the markets. That's what's going to happen. And why did they say that? Well, the markets have been shedding off tons of points, and the market's been tailwinding straight down. Some of the FANG stocks, which are the tech stocks, Facebook, Apple, Amazon, Google, Netflix, that makes up the FANG stocks, have shed off 63%, maybe even more now. You know, Netflix and Apple's been down and Amazon's missing. Every one of those companies has been shedding off. So if you own stocks in tech companies, you're hurting right now. But even if you own the S&P 500 as of yet, not today, but as of yesterday, you would have been down, I think, 13 or 14% year to date. And the Fed hasn't even got warmed up yet. They haven't even stepped up to the plate to swing. They raised rates twice. They haven't even begun to sell off the balance sheet yet. That doesn't start till June. And we're already seeing the markets shut off. How far down can it go? Well, it depends on who you ask and depends on what you want to believe. I think you're going to see at the end of the day an 80% shut off. That's right. That seems like you're like, there's no way that's possible. You bet your butt it's possible. Look at history. Follow the charts. The charts tell all. Can the market lose 80% of its value? Absolutely. And will they? If the Fed does what they say they're going to do? Yep. Probability of success is probably close to 0. And that is only 2 of the 3